Welcome, folks. We're going to give people a little bit of time to come in. My name is Steve Rothstein from Ceres, and again, we'll be starting in just a few seconds. Thank you for your time today. Again, welcome for those who have just joined. We'll be starting in literally probably 30 seconds, and appreciate your joining this fascinating discussion with this incredible panel we've assembled. Great. Welcome. My name is Stephen Rothstein. I am the Managing Director of the Ceres Accelerator for Sustainable Capital Markets. Thank you for joining us today. We appreciate it. And we have a really important report and a really stellar panel that you're going to meet in just a few minutes. Before I do that, I want to just cover a few administrative things before we get to the meat of this, which is really the role of third-party assurance in climate data. First is today's session will be recorded and will be shared after the event. And you're welcome. You'll all be receiving a copy, and other folks who have signed up. We welcome you to submit questions in the Q&A box at the bottom of your screen, and we'll do the best to follow up as many of them as we can during the session. If you need closed captioning during the event, please select the closed captioning button on the bottom of the Zoom toolbar. It's been enabled. Ceres is deeply committed to equity, diversity, inclusion. And while we remain dedicated to always providing space for experts in a conversation, it's equally important to assure our experts and speakers illustrate a diverse perspective. We acknowledge the lack of racial and ethnic diversity during today's session, and we'll continue to do better as we look for other folks. But again, the folks we have today are experts in their field. Next slide, please. Many of you we've worked with at Ceres. Ceres is a sustainability nonprofit. We've been around for about 35 years, and we focus on transforming the practices and policies that govern U.S. and global capital markets to reduce the worst financial impacts of climate change. And we've worked with some of the largest investors, companies on their own sustainability plan. Next slide, please. There's a lot of work we've been doing in these areas. I won't go through all the details today. Next slide, please. This is a part of our longstanding commitment in this area. This is a report we did almost 2 years ago called Lifting the Veil. So again, this is not what we're talking about today, but we have more information on our website. Next slide, please. And we have worked extensively with the federal regulators, most particularly the Public Company Accounting Oversight Board, but also the SEC and many others where these issues are really paramount. Next slide. As I said, we have an incredible group of distinguished colleagues I'm going to introduce. First, I'm going to introduce Samantha Ross. Sam is the founder of Assurance Mark and really the author of today's report and has written so much on this important issue. So deep thanks to Sam. Then we have Joanne Beatty, who's the Director of Engagement at EOS at Federated Hermes. We have Christine Sullivan, who's the Audit and Assurance Partner in Deloitte, and last week, award winner. Congratulate Kristen. And Dror Al-Qaim, who's from Legal and General Investment Manager, and as a global ESG analyst there. So with that, let me turn this over to Sam to give us an overview of what's in this report. Sam, thank you for being here, and thanks for all your great work.
Great, and thank you so much, Stephen. I want to thank you and the whole Ceres team for all your support for developing this report and the work that underlies it. I also want to thank my co-authors, Mario Abella and Robin Seatall, who are not here today, but were fantastic collaborators in both the process and the drafting of the report. This is a report on assurance and what kinds of problems it can solve. It's a deep dive on how assurance can be applied, as well as what conditions will be necessary for it to be applied appropriately. with the requisite level of quality to solve those problems. So our approach was, first, we set out to understand what investors think about the quality of climate data and where the most critical credibility gaps lie. The report is in large part the product of a listening tour among investors who use climate-related information to make investment-related decisions. We wanted to understand which data sets present the most challenges for investors and where better quality climate data would enhance the investment decision-making process. So we interviewed investors involved in governance, investment product development, investment analysts. We also interviewed professionals involved in data analysis and distribution of data, as well as assurance providers. We then synthesized what we learned from the listening tour into some themes. I'm just going to go over them briefly because really this webinar with this amazing panel is meant to be a discussion. But to just open us up and get our appetites wet for the themes we can discuss, the message from investors from our listening tour was clear and unanimous. The current state of climate-related information is poor. Thus, investment decisions often rely on data that's based on inconsistent methodologies and that lacks a systematic check on management biases. So we delved into some, in the report, we delved into some key challenges. The first being the poor data quality. There's investors also have concerns about limited disclosure and the lack of connectivity between sustainability reporting or climate reporting and the financial statements. There's inconsistent assurance quality, which makes it very difficult for investors to discern, what can be relied on and what shouldn't be relied on. And weak corporate governance practices that investors think underlie some of these other problems. Based on that, we came up with some recommendations to companies. First, we recommend that companies highlight considerations of their energy transition plans and greenhouse gas accounting guidelines in an accounting policy note to the disclosure that they're making. This is a common tool that's used in financial reporting context that has very clear applications in climate reporting. In addition, we recommend disclosing climate and sustainability data methodologies, key assumptions, and calculations in those notes. We recommend implementing effective governance over climate and sustainability data, including broader sign-off on emissions data. We recommend creating and documenting a clear data flow and climate data ownership structure, and engaging the financial reporting team in the collection and reporting of sustainability related information. And then finally, we recommend ensuring that the audit committee ensures all assurance providers, so there's one place in the company where all of the assurance kind of comes together and has appropriate oversight. We also had recommendations to assurance providers. First, we recommend creating lines of communication and avenues to collaborate across financial and sustainability data assurance teams. We recommend building in conditions that enable big picture thinking and reflection, obtaining training and building out capacity on sustainability and climate risks. We recommend engaging subject matter experts to be part of the audit team to help bridge the short-term knowledge gap on climate and sustainability matters. We recommend allowing investors' needs to influence the scope and the depth of procedures to support their confidence in information used in their decision-making, as well as we recommend explicitly addressing the suitability of a company's reporting criteria. This goes directly to concerns about greenwashing. And in addition, we recommend evolving assurance reports to meet the needs of investors, including adding critical assurance matters to the standard format of assurance reports on sustainability disclosures. Now, I'll note that there are company providers already implementing these best practices, but the markets need more consistently high-quality practices to maintain efficiency and promote reliable decision-making. While the recommendations are rooted in our discussions with investors, our discussions with auditors helped inform what is possible as well as what is needed. Auditor responses were extremely helpful to flesh out problems that they encounter and that companies need to address. So there's a lot more detail. The report provides a path to incorporate assurance over climate data to protect and reinforce our capital markets as companies meet the challenges of the energy transition. The report also discusses several types of disclosures that investors said would benefit from independent third-party assurance And we cover some next steps. Based on this input, we identified several opportunities to design protocols to apply assurance to using existing principles and practices to improve the quality of key information used by investors. So I want to stop there because we do have this amazing panel and want to foster as much discussion as possible about these topics. Thank you so much, Stephen, and everyone else here.
Thank you, Sam. And so first, we have two very important investors, Joanne and Dror. I'm going to have Joanne first, and if you can just talk about how does the quality of sustainability assurance, as outlined in the report, affect your decision-making process? And feel free to give a little background of your firm and as you're answering. Joanne and then Dror.
Thanks, Stephen. Joanne Beatty, EOS at Federated Hermes. We provide stewardship services on behalf of 60 plus clients, 1.4 trillion assets under advice. And we also provide voting services for some of those clients. Also, my deep thanks and gratitude to Sam and Ceres team for their hard work on the report. It's brought together so many great themes around this topic, and it's a nice, concise read. So thanks, Sam, so much for that. I think with so many companies making public environmental and social commitments, investors are increasingly turning to company accounts to understand their financial impact on those goals and plans. And third-party assurance has been a long-standing mechanism to protect investors, I guess, as well as the stability of capital markets. Assurance quality, however, is critical, and it was concerning to read in the report that inconsistent assurance quality was one of the findings. I think if you take climate data, for example, it's subject to so many different types of assurance engagements conducted by firms with differing independence requirements and varying skills and credentials. And we find it challenging to discern and weigh those variations and feel confident in the information presented. Audit quality is something we hold as EOS audit committees accountable for in our vote guidance. And we also look for evidence of a committee's rigorous audit selection, rotation, vigilant audit oversight. And these were things that the report made very clear. So back to you, Stephen.
Great. Dror, same perspective, just give a little bit about LGEM and about your thoughts about the role of third-party assurance.
Yeah, thanks, Stephen. Joanne, first of all, so LGEM is an investor predominantly based in the UK with around $1.5 trillion in asset under management, and I'm working in the investment stewardship team in LGEM. And having spent the last 10 years of my career in the ESG space, I must say that some of the statements made on Sam's report resonate pretty strongly with my own level of frustration from the quality of ESG data in the market. And to your question, I would say probably just to add some context from the lenses of a large investor, where part of my role is to help developing our ESG score, which is basically an assessment of around 20,000 companies across 34 different related ESG issues, from climate risks to governance to transparency. And what I can tell you is that I had spent an awful lot of time trying to find the data that is not only aligned with our views, with our expectations of companies, but also ticks the boxes of consistency, reliability, quality. And it's pretty challenging, right? And one of the reasons being because of quite a weak disclosure framework environment. So why is this relevant in this context? Because companies that adhere to meeting our minimum standards, both in terms of disclosure or actions, normally tend to get higher scores. And these scores then translate into more capital being allocated to them through a growing range of our funds that currently cover around $60 billion in asset under management and rising quite quickly. So, I think this is one direct link that you can draw between how improved governance and disclosure can allow investors to make better decisions and ultimately influence capital allocation decisions. So what we tell companies in the market is basically companies must treat their climate data as they do with their financials data. And it starts with effective governance, but also credible disclosure. Now, interestingly enough, as we have dived deeper into trends in disclosure in the market over the last 10 years as a proxy of our own scores, what we found was that company scores have improved quite significantly across the board, across different regions, sectors, markets, and this is mainly driven by improved level of disclosure. But at the same time, most recently, actually, like a month ago, we've taken a deeper view of 5,000 companies we invest in across 20 different or 20 climate critical sectors, as we call it. And we found that a third of them don't even disclose scope 1 and 2 emissions, which is the basic, I think, of climate related data. So, there's quite a big gap, I would say, to bridge. And when sought after decision useful, disclosure is predominantly voluntary, we as investors often find it challenging to find the right level of consistency and quality of data across our portfolios. And without getting too philosophical here, I will probably say that we all know the theory that efficient markets exist where all market players have the same level of access to the same information, right? And I think that one perhaps should ask a question whether the current level of information we have is enough or sufficient for us to make informed investment decisions. So, when I talk about material climate-related data from physical risks to transition risks, which again, this is where we see substantial gaps, I think, this is where mandatory reporting and assurance play a big role. And just to finish up with an example from my own role is that I'm leading on the energy sector here in LGIM. So, some of the most material issues for the oil and gas industry involve the energy transition, right? So if you take the IEA, OPEC, oil majors, they all may have, different assumptions, predictions, views about, oil and gas supply growth, about demand, about hydrocarbon prices, and they're all different. And I can tell you one more thing, they're all probably wrong if we judge by, past, assumptions and predictions, right? But I think there's one common ground that, we all agree on, or hopefully we'll agree on, is that the energy transition is not a question of if, it's a question of pace. And, this is why we have been calling companies through engagement with management, governance, directors, even collaboratively, or even by escalating our approach through shareholder resolutions, as we did last year at Exxon together with CBIS on AROs, to essentially provide more disclosure that is relevant to us and will essentially allow us to better adjust for the long-term risk the business might be exposed to. So yes, I think with companies recognizing how critical climate data is to investors, it's safe to say the stronger reporting and assurance landscape would absolutely benefit us as investors, and I would probably say the market as a whole.
Great. Thank you for both of you and those thoughtful comments from such important investors, and your reflection, again, both of you, that climate risk is financial risk is particularly interesting. Your study about the third of the companies not having scope 1 and scope 2 is sobering, but is really a call to action. So with that, I'm going to turn it over to Kristen from Deloitte. Kristen, how can this report serve as a constructive tool for effective communication with both investors and companies and regulators? And what opportunities do you see for enhancing the maturity of the assurance services? Thank you.
Sure. Well, thank you and good morning. So pleased to be a part of the conversation, and congratulations to Ceres and Sam and team on a really, really valuable report. I think as my fellow panelists have mentioned, there's so many really important insights that I think we've already drawn out in terms of the current ecosystem of ESG disclosure, and really what are those levers and steps to mature the overall quality of disclosure in the market to really unlock the capital to be allocated in a way that truly will help facilitate this energy transition. And, I think it's really important from an assurance provider perspective to step back and just sort of level set on, the role of assurance and assurance providers is really to serve the public interest. And in particular, our overall approach, the services we deliver, the conclusions we reach and provide is intended to enhance trust and confidence, as was reflected in the report itself. And so I think this is a really, really important tool to help just demystify, surface some of the complexity in this landscape that is maturing very rapidly. When you think about, we've got new standards, we've got standards that are going to continue to evolve. We've got new mechanisms and guidance around how companies, corporate actors, enhance the governance and controls around this information to be in a position to disclose information that will be the preparer would have an ability to withstand independent assurance. And then the assurance, building in the capacity to obtain assurance in a very compressed time frame. So I think we're just seeing a rapid maturity, and I think the central theme that we've seen across a number of the regulatory developments is, no surprise, the role of assurance and how incredibly important that is to help, as our investor panelists have highlighted, to enhance that confidence of users of the information. And so I think that, if you step back and think about how these insights in this report can really further strengthen this call to action for companies to understand that this is a multi-year process to get into a position with standards to rigorously apply criteria that standards establish, including materiality determination. How does that help inform an enhanced rigor around policies, procedures, judgments, estimates, as was highlighted in this report? I often say, greenwashing works both ways. There can be sort of intentional misrepresentation, but increasingly the absence of meaningful, complete, high quality information can be taken in as the universe of information that's presented and influence decisions in a way that really is not reflective of management's strategic focus, performance against their strategy and commitments. And so really, I think for preparers, it just really helps to highlight that there is a level of rigor discipline that rapidly needs to increase. I think what also is really extremely helpful, in particular for engagement between assurance providers and investors, is the enhanced clarity around what is the role of assurance, what does it include, and then what does the conclusion actually deliver to the user. And that's where you get into there's the distinction between levels of assurance, a limited assurance engagement, and what that conclusion means and how that can be used by an investor, moving to, which is very much the emphasis of the regulation that we have today, a very clear direction of travel to move towards reasonable assurance, which is a different level of conclusion and opinion that is delivered that reduces the risk of material misstatement to a much lower level. And that's really the level of assurance that investors are very much accustomed to and expect in overall corporate reporting, financial reporting. So I think it really helps to surface what's included and how that enhanced component of governance really helps to strengthen the quality, the completeness, and the decision usefulness of information. And then ultimately, transparency around the universe of assurance providers. What are the standards that are followed? No different than the importance of a baseline understanding of common standards criteria that preparers applied, but assurance providers. What are the quality control, the ethics standards that assurance providers need to comply with? This is all really important information for investors, for boards to understand as they proceed with assurance to really accomplish their objectives and to strengthen that trust with stakeholders. And so I think those are some really key components of the report that help to really enable this report to be a valuable tool for assurance providers with investors and companies.
That is very helpful. You've raised a lot of the quantitative and qualitative information. Kristen, quick question back to you. How much are you hearing this from your clients compared to, say, 5 years ago? The issue of assurance on climate-related data. How much is it part of the dialogue versus what you might have heard 5 years ago?
Yeah, we've definitely seen a dramatic increase. No surprise, I think, as the sophistication of the market, the recognition of the climate risk as financial risk. We, as a firm, as a profession, have been delivering assurance over voluntary reporting for over a decade. But I think the latest stats of our global assurance profession survey indicates that over 98% of companies provide information, and about 64% of companies obtain assurance from their assurance provider. And I think that's grown dramatically over the past couple of years. We will see very clearly with regulation establishing that mandatory requirement that will increase. I do think, though, what has changed is the level of engagement with boards as audit committees, as was cited in the report, the role that audit committees play in delivering on their oversight responsibility around disclosure and how information is relied upon, and how that obligates the board to get really clear on the governance structure, the oversight responsibilities, and how those oversight responsibilities are operationalized. So we've seen that very much help to drive that increased demand for assurance and a recognition of the value as boards become much more engaged.
Great, very helpful. Dror, back to you. Before that, just want to remind the audience that if you have questions, please put them, put a note and we'll get to them a little bit later. But Dror, in what ways do you believe effective stakeholder engagement can be improved in the context of climate-related reporting and assurance from your experiences?
No, yeah, it's a good question. I think one of the tools to bring meaningful change is through collaboration. And by collaboration, what it means for us, being the stewards of our clients' assets, is that our engagements don't stop with the companies we invest in, right? I mean, they extend to a broader group of stakeholders like policymakers, NGOs, think tanks, regulators, even fellow investors. I think because the one and most effective way to drive progress is by connecting all the links in the chain. And when it comes to company level engagement, we, for example, take a model of engagement with consequences as part of our approach to stewardship. What it means in practice is that companies that fail to make sufficient progress against our asks, and many of them are disclosure-related asks, normally tend to be more exposed to voting sanctions, to a lesser extent, divestments, and also shareholder resolutions, by either us supporting them or filing them. And I think that if we stay on the shareholder resolution space, because it's quite interesting and important for the point of the question, this is where we've seen this is a tool we've seen utilized more and more in recent years, and it's basically utilized to encourage progress against different topics, mostly social or climate related. And I think even last year was a record-breaking year in terms of the volume of shareholder resolutions that filed in the market, most of them in North America, keeping us very busy. But even though their momentum has somewhat been lost with the average support level year on year on a decline, some issues we supported have taken quite a spotlight in terms of market-wide debate. And as I touched on earlier, again linked to the proposal we co-filed last year, but one of these issues is around asset retirement obligations, so AROs in short, or decommissioning costs if you are based in Europe, like yours truly, which basically is an extension of a wider topic, being the disclosure of material, decision useful, climate related data that is essentially interlinked with financials. So just to clarify on the point of AROs, while it can be or it can sound quite complicated, I think the disclosure ask is incredibly simple, because as I said earlier, companies might have different views about the pace of the transition, and on the back of these views, they make their own assessment and their own investment decisions, and their own assumptions around how long into the future they'll be able to run the long-lived assets, right? And what you get on the balance sheet is a potential understatement of the liabilities they might have to record if the outlook changes. And in a carbon constrained environment, for example. So this is exactly the information that we are seeking, that we are after. Disclosure that provide us with sufficient visibility into the full magnitude of the potential liabilities that the company might be exposed to, or in other words, what is the potential risk exposure for us as investors who may have different assumptions than you. So we're just looking for the delta. Now, just to finish up on this point, this is an area that we've had growing number of conversations this year with relevant stakeholders, again, with a view to sort of like leverage the momentum in the space and, as the report outlines, encourage standard setters to meet market needs for more granular, climate-related decision useful disclosure. So I will just end it here.
That is great. Yeah, and the work, I mean, your note of arrows and the implication of other industries is so important. Joanne, I'm going to go back to you. How has this analysis influenced your perspective on engaging with auditors on this topic? Joanne?
Thanks, Stephen, for the question. The report, I'm really pleased that the report's reinforced areas that we as EOS have reflected in our corporate governance principles and vote guidelines for many years. And, we look to the audit committee to really demonstrate that it both independently selects and engages the auditor separately from management, and that the audit committee itself directly oversees the auditor. So in our opinion, and as I think the report reinforces, audit independence is critical. For example, for us, we pay very close attention to the non-audit consulting related services, and particularly so when a number of audit firms and assurance providers are also providing consulting services at the same time around climate related data and information. And we want to ensure that those services are not compromising audit independence, which then could in turn compromise the reliability of information. Think, for example, one of the risks on self-review risk, you're actually auditing data you produced or part of your firm produced itself. So we expect the audit committee to establish and reinforce and enforce a policy on what non-audit services the company can procure from the external auditor. And we also believe that independence and potentially audit quality is at risk when the same assurance provider, particularly in the US market, is maintained for too long, whether that's the firm or the audit partner. And finally, I think as the report recommends, when selecting an unregulated assurance provider to verify or test climate-related data, for example, I think it's critical that the audit committee satisfies itself that the provider has in place a robust and transparent ethics framework, and these were things that Kristen touched on, that demonstrates independence, as well as a rigorous system of quality control over the verification engagement to ensure procedures and judgments are applied consistently. Back to you, Stephen.
Thank you. Boy, we could just spend the rest of the time just on those points alone, from the independence, the role of the committee, the third party, the other consulting. There's so many important topics. But in the interest of time, I'm going to keep moving again. But thank you for raising all those important points. Sam, based on your deep experience in this field, how do you see the future of assurance practices evolving? Could you elaborate on the significance of integrating sustainability reporting with financial reporting, especially regarding the inclusion of climate risk within financial reports?
Thank you so much, Stephen. And I'm going to echo some of the things that we've already heard on this webinar, but as you've heard, investors already do integrate in their decision-making all kinds of information, because it bears on how investors see the company's future outlook. It bears on estimates of the company's future cash flows, estimates of the, ideas about the viability of company strategy. And they're not just looking, and they never have just looked at the financial statements themselves, which are themselves reflections of management's estimates about future cash flows. But investors want to know, well, what underlies all of that, those judgments, and what risks can affect those judgments that will mean that the company may undershoot or overshoot what they're predicting. That has a huge impact on investors' outlook. So in terms of integration, I think, we probably will over time move more toward formal integration of disclosure. But meanwhile, we're already there in terms of investors taking in information from a variety of sources to make decisions about their investments, whether to invest, how to vote, whether to, when to sell an investment. Now, saying that, assurance has been limited to the financial statements primarily in the past. That's changing, as Kristen has been describing. what we're talking about here is aiding investors in their integrated thinking about a company's outlook with existing tools. And insurance is one of the key tools that we have. It's been a tool that's been very effective in promoting efficient financial, financial statements that are reliable and efficient capital markets, but it doesn't yet fully help investors get that reliability that they want of the full picture from the company. So it's really just been natural, I think, that the market has been more and more seeking and rewarding companies for seeking assurance. Now, where do we go from here? Companies have decisions. I mean, obviously, there's market pressure on companies to make voluntary disclosures. Most large companies now do make very wide-ranging voluntary disclosures related to climate and a host of other kinds of risks that investors are interested in. And to some extent, investors have been using additional tools, including even assurance. That I think, some companies are doing it because they're pushed to, and they are just doing what they perceive to be the minimum that the market will bear for example, just to get a rating from a rating agency that they, sort of a check a box. I would argue that's really short-sighted and not a good decision, because the board has a great opportunity to think about the long-term relationship with the capital markets and building trust in the capital markets with the company's overall disclosures, and high quality third-party assurance that really does signal to investors reliable information that there has been a deep probing and that you've got an independent third party standing by the process and the testing that they've done to say, yes, this reporting is complete. There are no major material omissions, as Kristen was talking about before. It's not just about whether there's a misstatement, but whether there is important information missing from the statement that's covered in the audit, as well as the opinion that the assurance provider provides that the information is accurate, is fairly presented under an appropriate, suitable framework. That's got real value, not just to investors, but also to companies, because in building that trust, an audit committee that thinks more broadly about how to use assurance to build a strong relationship with the capital markets is really making an investment in future ability that the company will have for satisfying its capital needs when it has big projects, for keeping the market support for the company as the company faces headwinds. That's something that's really critical. It's the role of the audit committee to be thinking ahead that way, and just getting the bare minimum of doing the minimum kind of disclosure that the company might think some market participants would be satisfied with, or the minimum kind of assurance, because it's not required, whether it is mandatory and there's a mandatory minimum, or whether it's not mandatory and they can just decide. I think those are, going that path is short-sighted. So Stephen, your question relates to where do we go from here? What's the evolution? I can see two possibilities. I can see a path where decision makers decide, well, let's just go with the minimum. We'll wait till we're told to do these things. Or we can think more holistically, more broadly about how do we build credibility in the markets that will serve us well in the long term. That would be a great path for companies to take. I'm so pleased that investors are encouraging companies to take that path, as well as that the assurance providers, the accounting profession leading the way, are thinking about how to meet that need with the requisite skill sets.
That's very insightful, and I definitely hope we'll see what the future brings, but I'm sure we'll get there faster because of, to be honest, Sam, your work and the efforts that you've been doing. Kristen, back to you. So the report emphasizes the need for auditors to enhance their understanding of climate and sustainability issues. How are you doing that within your team, and what are you hearing from others and your competitors in the industry?
Yes, no, thank you for that question. And maybe just building off of Sam's comments, Sam, I know you say often the value in more rigorous, high quality disclosure helps provide that insight into the through line, right? We've got the financial statements. We've got all this other information that is quickly becoming sort of the coalescence around more standardized, consistent, transparent approaches to capturing, measuring, and then ultimately disclosing that information. But absent the connectivity into how those risk indicators, how those performance measures truly connect into risk as it's captured in the financial statements, investors are left without sort of that broader understanding. And I thought one of the quotes or the observations in the report was really, really important as we talk with companies around the value of assurance. And just to further reinforce that point, this enhanced confidence that assured high quality disclosures provide to investors that can deliver on lower cost of capital, and how that practically, I think the reference is that boards and management are given a bit more leeway to embark on these major transformative business transformation. So I think it's really important to emphasize the value proposition further around how companies navigate, right? There's trade-offs in every step of a process of enhancing the value and usefulness of corporate disclosure. And so assurance is such a critical plays such a critical role. But back to your question, and I think it all ties together, just given the role of the audit profession, and importantly, this emphasis on the product that's delivered, the audit reported, and increasingly the assurance that exists today, the standards that the use of this tool exists today. We as the audit profession have been, as I mentioned before, in this business for decades, in terms of performing assurance on information outside of the financial statements, and increasingly as we're working with our clients, really bringing that lens to risks. How do we make sure that we're thinking about information needs, how risks can manifest, and actually integrating that into how we deliver our services from an audit perspective, as well as more broader assurance services. We've been taking steps for many years, the profession broadly, to educate our entire audit and assurance practices around the important role, how this aligns to our public interest role. We have continued to advance our assurance methodologies, how that plays into the delivery of our audit, how we think about risk, how we assess risk, how we test. And the critical emphasis on education and upskilling and learning that is very much a central feature, and has been for several years, to really upskill our professionals more broadly, understanding the role that we play increasingly as voluntary assurance, which has been the practice to date, moves to mandatory assurance. And I think the important what we're seeing in terms of in practice, as the financial statement auditor is much more engaged in performing, helping to strengthen the rigor, the discipline, the consistency of reporting outside the financial information, that really helps to support the company in accessing more timely, high quality, decision useful information to truly better reflect the performance across all of the corporate reporting. And so there's a tremendous value that can be delivered as the company really rapidly matures from sort of information that's presented much after the financial reporting, to how do you pull that forward? How do you gain access to more timely insights, sense more effectively the risk and opportunity trade-offs, and ultimately provide that information that truly is going to be standardized, consistent, and really enhance confidence.
And do you feel, is that consistent across your field, and that everyone is as bullish as you are in terms of the opportunities?
Well, the profession overall is has been very engaged in this whole evolution in corporate reporting. I mentioned before the IAASB, so the body that sets audit and assurance standards globally, is proceeding with, and I think really is demonstrating the importance of the assurance profession evolving rapidly, no different than the disclosure standards and corporate actions. And I think that's really going to be demonstrated in the rapid acceleration towards a sustainability attestation standard that we should see by the end of the year, and a number of really important factors playing into the development of that standard. I think importantly, it will highlight a lot of the points we've talked about, bringing greater transparency and connectivity to the ethics standards board, that's also sort of tracking similarly with standards around governing sustainability assurance providers, who can provide this information, how the standards are applied, and the transparency around that. So I think the profession has really leaned in a really meaningful way, and that's critical to this market evolution.
Great. Can you briefly talk about, the report talks about critical audit matters. Just what are those? And what are the ways that they're currently being used or should be used more to identify climate risks in the statements?
Sure. Well, I think the reference to CAMs in the U.S. context, the CAM, critical audit matters, and the KAM, key audit matters. I think the overall emphasis is very much, first of all, focused on the audits of financial statements and really putting some, effort around delivering greater transparency around areas where the auditor has leaned in and tried to understand and delivered greater insight into how risks were evaluated to some of these key disclosure areas. So to be clear, this is the emphasis currently today is on the financial statements themselves and the audit of financial statements. Now that you can correlate that to this evolving practice around assurance of information outside of the financial statements. And actually, this is something that, as I mentioned, the standard that is under development, the attestation standard for sustainability under the IAASB, that there is a consideration to this concept and how that could be reflected in the enhanced standards that we will see by the end of the year. I would say even absent a very clear focus, emphasis, requirement around disclosure of these critical or key auditor assurance matters, assurance providers do currently have the latitude to highlight areas of particular emphasis, a particular focus that the assurance provider would believe would provide greater insight and transparency to the user of the report to understand where higher risk areas existed and really how those were evaluated. So there's a current, practice and some latitude that I think we'll see evolve. And I do think it's important that we see how this in particular, this area will be reflected in the revised standard that we'll see by the end of the year.
That's great. And by the way, if anyone wants to see Ceres submitted comments to that, if you want to see it, feel free to email us. We're happy to share it. Sam, two related questions. One, that was one of the ones submitted. What do you think the Public Company Accounting Oversight Board should consider at this time? And what do you see as the role for the SEC, and what do you expect to see from them?
Sure. Thanks very much, Stephen. So on the PCAOB, I think that the risks that we've been talking about are very important for the PCAOB to be thinking about. I mean, as everyone on the panel here has described, the financial statements are based on assessments of risks. They're based on assumptions about risks, assumptions about opportunities. They can all be impacted by a host of risks, including climate risks and risks related to the energy transition. The more that the auditor knows about those risks, the higher the quality of the financial statement audit is going to be. And that's why I think it's critical that financial statement auditors have that window into these broader set of risks. Where they don't, where you have a different provider working on climate-related assurance over climate-related disclosures, or no assurance over climate-related disclosures. Today, under existing standards, there's not even a requirement that the financial statement auditor read for example, the sustainability report. Now, I know most good auditors would certainly read a host of information that the company puts out, but like I said, that other information information outside the financial statements may have a direct bearing on what's inside the financial statements. It affects the audit, it affects the audit planning, the testing, and I think therefore it is something the PCAOB should be focused on as well. Now, your next question was about the SEC. I thought it was fantastic that the SEC proposed to have assurance over important climate information that's not in the financial statements. I don't think there's any real, strong rationale for limiting assurance to just the financial statements. So I was very pleased to see that they did that. I hope they finalize it. I think it's great that they, laid out a roadmap for how companies can over time improve the quality of their disclosure through, increased levels of assurance. And it's important to get to ultimately to that reasonable assurance, that investor grade assurance that, Kristen touched on this, but reasonable assurance, bottom line is for investors, it means that's an opinion of an independent third party that the disclosure is accurate. There are no material misstatements or omissions. That's an opinion. Limited assurance does not deliver that kind of statement. And it doesn't involve any testing. So I do think it's important to make the way to reasonable assurance. Now, saying that, even if that becomes mandatory, there's still going to be a host of choices that audit committees and boards have about the scope and depth of assurance. And as we've described much more deeply in the report, I think it's really important that audit committees think holistically, that they choose providers that are going to deliver high quality work, and that they be very careful to make sure that that work is very well integrated with the financial statement audit. And they really think about how they can use assurance to build trust in the market and position the company well for any big strategies they want to take on, or even just, facing headwinds that come up in the market.
Great. Thank you for those comments, both on PCAOB and the SEC and the pros, and what limited assurance does and doesn't do. I'm going to turn back to our distinguished investors. Joanne, first you, and then Dror, and feel free to go into this in as much detail, or if you want to skip it, that's fine too, in terms of some of the questions. Can you talk about the relevance of the accreditation of assurance providers? For example, is the accreditation of the assurance provider for greenhouse gas reporting by a ANAB an important demonstration of their competence or impartiality, something that clients are looking for or not? Joanne, but first to you.
Thanks, Stephen. It's a good question. For us, I think it's about the requirements, the professional body requirements that we see with the big four, the tier 2 auditors versus others that provide more the verification, attestation services. We have a lot of confidence in the professional requirements for the auditing profession and the role that the PCAOB provides as well in looking at the quality of those auditors in their work. So I might just leave it at that and pass to Dror if you've got some comments.
Sure, thanks, Joanne. Just one very quick one. I think Kristen mentioned before the ISSB, and just looking at how the ESG space has developed over the last 10-15 years, right? From the creation of the GRI reporting to CDP, SASB, TCFD. I mean, I can spend an entire hour talking about acronyms in the space. But to your question, I think we don't have a view in terms of like who is better or who is more credible or not. What we are seeing is that we are moving to more materiality level disclosure, right? So companies in the past, just try to kind of like come up with disclosure around hundreds and hundreds of metrics, which, the majority of them just weren't relevant to them. And, with time, we moved into more like a materiality-based disclosure, and this level of disclosure is important for us to get assured. So this is what we are pushing for, right? I mean, don't give us, don't throw the kitchen sink on it. Just provide a level of assurance on the data that we really want to see that is really interlinked with financials. So yeah, I would just leave it there.
Great. And I'm going to continue with both of you, going back first, Dror, and then Joanne, this other question, what percentage of limited assurance audits that you've reviewed, did you actually find helpful or relevant? And did you actually find the level of quality you might expect based on the reporting of ESG related claims and some of the current risks that are happening? Is it a lot? Is it a few? Is it none? Curious of your sense of limited. And again, feel free to talk generally specific, or we can skip this, whatever you prefer.
Yeah, it's very broad, and I think it can be probably answered in different ways. But I don't have an specific answer to the question, but I can tell you, from just an example of some examples of assurances report that we've seen in the market for data that we were requesting. And, normally the assurance report come up as like, 1 or 2 pages, as in like, hey, yes, we reviewed, the statements made by the company, and we agree with, that it's accurate and it's reflective, and the company is going to be to do very, very well in the future. But we don't get the level of data that we want, the detail behind it, the assumptions that Sam was talking about beforehand, the input, the prices, the different scenarios, and the more quantitative level of disclosure. So yeah, I think this is where we'll probably find some difficulties, and we hope to see this progressing in time. Again, with the creation of bodies like ISSB and perhaps even more as time goes by.
Great. Joanne, do you want to add anything on this point?
Just that, limited assurance is limited. So there's only so much that it can review, that an auditor can review under limited assurance, and it's negative. It's looking at what wasn't. There was nothing found that was problematic. So in that, often there's not the scope to look more widely at everything that the issuer is doing and ensure there's completeness across all those documentations, that there's alignment between those documentation and disclosures. So, again, I think, these issues were teased out very well in the report, and some great suggestions to help that improve over time.
Great.
Yeah, Stephen, if I could just jump in just really quick on that point, because I think it's important just to emphasize that, by design, the purpose, there's a very clear purpose, right, for what a limited assurance engagement is intended to achieve, and the transparency around what it delivers. And so I do think that there is a bit of demystification needed in terms of how we look to sort of moving from limited to reasonable assurance, what that means in terms of what companies need to be prepared for, and also sort of what's involved. So I would just echo that, or just emphasize that while limited assurance, to Joanne's point, is very limited by design, there's tremendous value, though, as companies continue to mature, and how that can help rapidly accelerate the maturity, even just analytical procedures that can surface missing information anomalies that management might not otherwise have flagged or understood. And it does drive a really important discipline. However, the conclusion of that engagement is clearly much more limited. But I just wanted to highlight that there's very much, I think, by design, that value in tracking to the maturity that the market's looking for, and the enhanced transparency that it provides. And then just the other point in terms of, as a condition for assurance providers to deliver on either a limited or reasonable assurance engagement under our professional standards, there does need to be clarity and transparency around the subject matter competence, the domain, no different than areas of the financial statements where technical expertise needs to be brought in for very specific analysis, risk evaluation within financial reporting. That's no different. And those are the enhanced steps that many in the profession, we Deloitte, are taking to increase that capability set, the technical competence that we're required to deliver in terms of delivering on the standards.
Very good. Excellent point. Sam, as the author, I'm going to give you 30 seconds if there's literally one point you want to make before we wrap up.
Sure. Thank you. I mean, I just want to thank this whole group for coming together, all the support during the process, and then also, helping to elaborate on the report today. I think everybody's made such great points. On the limited assurance point we were just discussing, Kristen, you really nailed it. limited assurance is useful as a stepping stone, is not a resting place. And a question just came in about, well, what would be needed to improve limited assurance? I mean, limited assurance is not meant to be a resting place. And audit committees or boards that decide to get limited assurance as a tool, if they just stick there, when they eventually move to reasonable assurance, they could find that once you do testing, which is not required in limited assurance, but then you do in reasonable assurance, that they have errors. So it's a great tool for as you're ramping up and getting ready to have investor grade disclosures. But pretty soon companies, just for their own reasons, forget about the regulations, for their own capital market reasons, should be moving toward reasonable assurance.
Great.
To deliver
Thank you.
quality.
Thank you, Sam. Thanks to all the panelists. Can we just put up the slides? Literally, as we wrap up, I encourage everyone to think about this. Please, we welcome your feedback. We'll also be sending out an email on that. Next slide, please. We also encourage the PCAOB to take action. This is an initiative about some of the anti-ESG, freedom to invest initiatives. We'd love to, again, talk to you about that. This is a course. One of the key things is for boards and audit committees. This is a course we teach with University of Michigan. Next slide, please. We're doing a big event in Washington. We'd love to chat with you about that, about trying to work with our lawmakers. And last slide, then we have a variety of other reports. And then last slide is with deep thanks. Last slide is to the panelists, to Sam, to everyone who's behind the scenes. And I hope you all have a great day. Thank you very much. Thank you. Bye-bye.
Thank you all.